We have Rahul Arora, CEO, and Girish Pai, Head of Research at Nirmal Institutional Equities, who join in to discuss the fundamentals of the market. And it is also the 8th anniversary of Nirmal. So congratulations, Girish, as well as Rahul. 8 years ago, Nifty was at 6350. And so nobody expected the Nifty to be at 11,000 one day, 10,000 today, or whatever it is. So it's been a long-term journey, and it's been a wealth-creating journey in the past 8 years. So is that what you're recommending to your clients, Rahul, that just stick on through the volatility and look at the markets 8 years from now?
Well, hopefully if they compound at the same rate that they have been, will be much higher. So it's been about an 8% CAGR over the last 8 years that we've been in existence. FD rates have progressively come down over that period of time. So if you look at it just objectively, you probably think that, the returns have not on a CAGR basis been too much better than fixed deposits. But I think this last leg of the rally that we've seen, which began in September 2013, I think at any 1,000-point interval, if you came in, despite this 15% correction you've seen on the index, you are still sitting on fairly hefty profits. If you entered at 5,100, which was September 13, or 6,000, 7,000, 8,000, 9,000 even, I think the way the rally has been quite stupendous. Obviously, there is a lot of cloud of uncertainty where we stand right now, but our own view is that at 10,000, there is not too much to lose on the Nifty from here. I personally believe the bulk of the correction is done. And if you believe that your price has come in stocks, it's not a bad time to start entering the market. Could we be growing at an 8% CAGR from here for the next 8 years? I don't think that would be a bad place to be at all. I hope so.
Congratulations, guys.
Thank you.
Girish, what's your view as far as, you echo what Rahul is saying here?
See, the 8% CAGR is actually a disappointment. And I think the reason that's happened is because earnings have not really grown. So at the index level, earnings have grown in mid-single to maybe high single-digit territory. And that's the difference between this bull run versus the previous bull run of the 2003 to 2007 situation. So at that time, index earnings were compounding at something like 30% on a CAGR basis for almost 5 years. So that actually led to a situation where index went up much more dramatically. So not only was there a P multiple expansion, there was almost a phenomenal earnings expansion that happened. So what's missing this time around is earnings growth. And it's come, but it's come, in my opinion, a little late in the day, in the sense that we probably...
I'm not sure if it's really come, right? I mean, it's still half the year.
No, I think it's come. I think the fact that the earnings have not really been delivering is because corporate banks have not been delivering earnings. I mean, we've actually seen very large losses in some of the large PSU banks, and even some of the private corporate banks, which I think is a turnaround situation as we speak. So we think that second half of FY19 should actually see very strong YOY earnings growth for some of the corporate banks, which should feed into the index earnings growth. But otherwise, if you look at ex-corporate banks, I think the earnings picture has been fairly decent. So I think one of the key culprits has been corporate banks, commodities in this bull run, which were actually contributing to growth in the previous bull run.
Okay. Rahul, you all have been looking at Yes Bank quite closely, correct? That stock is now up 7.5%. It's bounced back. But what's your interaction been, say, with the management post Q2 numbers, and what are you telling your clients also?
So, Ekta, it had come down to about 170 odd not too long back, and then from there it had quite the run to about 260 in almost a linear fashion. I think the market will now await the next change in management, who gets appointed at the helm. I think between now and then, at best, it remains a trade. I don't think, I'd probably be as comfortable recommending a buy at 200 right now as, say, we were at 165, 170, where we believed it was probably it had come down to one-time price to book. So I think I don't know, how much of kitchen sinking will come out even from here under the new management. Obviously, some bit will. You may get this stock a little cheaper. There could be another revisit of 165, 170. I think if that price comes in, it's a lot better to come in. And as Girish was saying, I think if you are wanting to play corporate banks, I think an ICICI Bank and Axis may be a better way to play it right now, with some amount of certainty at least. That's come through, and you've already had a change of guard recently in ICICI Bank as well. So I think that the key trigger for Yes Bank will probably be the change in management, but probably not the top pick on corporate banks at this point in time.
Girish, this ICICI and the results there is rubbing off on PSU banks as well. I mean, actually, PSU bank results also show that slippages are coming off, etc. Any thoughts there? Or again, I mean, we've seen many of these 30, 40, 50% rallies which get sold off eventually. So it never really lasts. What's your view there?
Right. On PSU banks, it's again a trade. It's not so much of a situation where you can take a structural bet on these companies. Until you have a situation where the corporate governance changes, I mean, you have a situation where the government actually pares down its exposure below 51%, and you're clear that there won't be further interference in loans that are given out by some of these companies, which in the next down cycle could potentially become NPA. So once that is not clear, I wouldn't think that PSU banks are a structural buy. They're a trade at best, and obviously, yes, we have a situation now where I think the worst is behind us. I mean, we keep saying that quarter after quarter. We've been saying it for the last many years that, the worst is behind us. Probably for the very first time, we can actually say that, because we have a situation now where incremental slippages have been much lower than what they were in the past many quarters. So, yes, there is a data point there which indicates that worst is behind. So, therefore, I think it's rallied. But I don't think it's a structural bet as we speak. Even SBI, in my opinion, it's a good company, but the worry there is whether somewhere down the road you will have some of these weak PSU banks, small PSU banks being clubbed with SBI at some point in time, because we had a situation where Bob faced that, and somewhere down the road SBI could face a similar situation. So maybe it could be a year and a half down the road. So it's not a structural bet.
Okay. Girish, just a quick last word in terms of the pharmaceutical stocks. Lupin is down post the management commentary, and we had Dr. Reddy's, which is, affected by this whole 8 observation issue at their facility. Till now, what have you read from the numbers?
So my analyst tells me that the incremental pricing pressure is kind of coming off for the sector. I think we have a positive view on the sector. We've been having it for a fair bit of time. And the reason why we've had it is because we felt that the pricing pressure is going to kind of ease. And also some of these FDA action that's been impairing growth for the companies will probably come off. I think we felt it's a transitory situation, but the transitory situation has gone on for way too long. So we think that situation is probably going to remedy. We've had a couple of cases where things have kind of improved. So from the pack that we cover, we still like Dr. Reddy's, we like Aurobindo, we like Cipla. And we like an MNC pharmaceutical company called Sanofi. So these are the 3-4 stocks that we've been kind of recommending to our institutional investors.
Girish and Rahul, thanks very much, both of you, for being with us here.
Thanks
on the show today. Thanks indeed. 32 points lower on the Nifty, 10,353 is where we are at. There is some more convergence, not convergence, but the number of stocks which are higher is